Hi, I'm Owen, the host of the Australian Finance Podcast. This podcast is proudly sponsored by BetaShares, one of the leading providers of ETFs here in Australia. Serving thousands of financial advisors and over 1 million investors, BetaShares manages tens of billions of dollars on behalf of investors right across the country. I'm proud to partner with BetaShares on the Australian Finance Podcast, Australia's premier financial podcast, because there is great alignment in the long-term philosophy shared by both businesses. I hope you enjoyed this episode of the Australian Finance Podcast. Good morning, good evening, good night. Gemma Mitchell, wherever you're listening to this, good evening to you or morning. How you going, Gem?
I'm going great, thank you. How are you?
I'm pretty good. Just a wee bit stressed with work. I think it's good to be honest. I think since COVID, everyone's gone back to not being 100% honest about how they're actually feeling when they're asked. But I think it's been a bit stressed with work. There's been a lot going on. So chugging through this week and looking forward to a holiday in around about 10 days.
Oh, where are you going?
Going to Palm Cove for 3 days and then up to Port Douglas for a week, which is just half an hour north of Palm Cove, just up near Cairns. And then going back down to Sydney for a week. We're doing a big event in Sydney, and Sarah, my wife, and Charlie are coming with me, and we're going to stay in a very posh part of Sydney. So don't judge me for this. We found a really reasonable Airbnb in Double Bay. So
Double Bay is nice.
Yeah, in Double Bay. I don't think I've ever been to like the little waterways there and stuff like that, but going to stay there for a week in an Airbnb and work from Sydney for a week. So really looking forward to that and the trip away. What have you been up to?
Busy, always busy. This week I've had some corporate, did a couple of corporate gigs yesterday. So that is where we go into businesses and we talk to their employees in a group session workshop. So usually I kind of do these around superannuation or investing or just, foundations, all the basic stuff. And yesterday's was around cash flow. So I ran a couple on, what did we call it? 5 steps to cash flow confidence, called that. So that was always fun. So this is like a really good initiative that, employers do that we offer here. And actually Lexi Smith and I have a podcast episode coming out in the next few weeks all about these sessions because she runs them a lot as well. How you can get your employer involved, what kind of stuff we cover. But yeah, so that is very topical because we've got that podcast coming out and I was doing those yesterday.
Cool. That's great. Yeah, there's an interesting thing for any of the employers that are listening to the show, or if you work in like a HR team. A lot of the data seems to suggest that if you have an employee assistance program, like a financial wellness thing at work or just a wellness thing in general, the actual finance part of that is the most utilized. So if there's some sort of services or workshops or things you can offer to your staff, it actually probably has the highest ROI of the EAP services. So it's actually really cool.
Absolutely. Like it's really hard for employers to provide everybody with pay increases. So where you can add a lot of value is, well, how do they make the most of their finances that they've got? How do they structure things? Like these programs are so good. They add so much value. And yeah, it's about teaching money skills and like the stats around how much money stress impacts people's ability to work, the time that they spend at work, either managing or stressing about their finances. It's huge. So these are really, they're becoming more and more popular, I would say, because staff, like employers need to show benefits and, have these amazing programs that make people more comfortable, makes their paychecks go further, and also just makes them a more desirable employer, I reckon.
Yeah, for sure. Today we're going to be answering some questions. We've got questions about how to do ETF comparisons, like how do you get them side by side. We've got some money tips. I've got some investing tips. We've got someone that's salary sacrificing into super, probably over the limit of $30,000 a year. What happens when you're caught over the limit? Well, there's things that can be done, so that's good. We've got a question about Raiz rewards as well, as a few other things, a great wealth transfer. So if we do answer your questions on the show every week, that it's general advice only. What that means is that it's not specific to you, your needs, goals, or objectives. So don't act on the information until you've spoken to a financial planner. And if you don't know what your needs, goals, objectives are, if you don't know what your strategy is, you probably shouldn't go and change super funds or invest in an ETF until you get clarity on that. If you're a bit unsure about what those things are, you can read the product disclosure statement or PDS. So for a super fund, for example, the PDS is the document that tells you everything about the super fund. And finally, if you're unsure of what Rask does, you can head to rask.com.au/FSG, and that's where you'll find our financial services guide. That explains what we do. So all key documents, all important. Fortunately, we're not going to get too in the weeds of some of those stickier things today. So hopefully we don't need to worry too much about any more warnings. But there was a question that came through from No Name. And I did see this come through and I kind of glazed over it. But seeing that didn't you write a book recently, Jem?
I want it to be known that I did not send this question in. I promise.
This is a planted question.
I was like, when I was picking this one, I was like, oh, he's totally going to think I just picked this one. But yes, No Name, which is not code for Gemma, has asked, can you make a link with all the wonderful books your staff have written, please? Now, this is not just me. This is what we've got. Drew, Pete, Kate, who else?
Yeah,
definitely Gemma Mitchell, the Money Reset.
Definitely Gemma Mitchell. Yeah, there's been some good ones. Like Pete's done 7.
Yeah, that's ridiculous.
Drew claims that he's done 2 books, but no one ever heard of the first book. So he's actually going to bring me some books. I don't know if he's bringing me some books today, but we may be able to give some more away. So The Golden Years is his book. How to not stuff up your retirement. You can find it online or just email drew@wattlepartners.com.au for a free copy. I'm sure he'll love me telling you his email address. Reach out to him. He's got plenty of copies and he's got plenty in general, so don't worry about that. He can send you a copy.
I looked up Drew's on Amazon and they're all sold out. So he must be hoarding them at his office. So yeah, definitely go direct to him.
I think him and the kids have built a cubby house out of the books that him and Jamie have written. So yeah, no, so we'll put links in the show notes to all of those. But if you do want a copy of Drew's book, I think he does have a few available, particularly if you're in and around Melbourne. Come grab one. Kate's book is still, I think you can still get copies. They were doing a reprint of it not too long ago,
and
which is absolutely
Buying
fantastic.
Happiness? Is that
Buying Happiness, yes.
Yes.
All about like the psychology behind money and how you can use money to live a more fulfilled life. Pete's done quite a few. Actually, it was Pete's first or second book, Get a Financial Grip, which really resonated with me when I was younger, because it was like he did this massive transformation. He went from drinking at the pub every Friday night, classic Englishman, to then like meeting his wife, Heather, who's a wonderful role model as well. And just transforming their lives in like 3 years. It's amazing. So really, really cool stuff. And then, of course, The Money Reset, which is out now.
The Money Reset by Gemma Mitchell. It is out now. Buy that on Amazon.
Buy it on Amazon. Yep, absolutely.
Buy it on Amazon. Or Booktopia. All good bookstores. Isn't that what we're all
Support your bookstore. Or go to the library. And get
it is actually at the library. Yeah, I got a report the other day from Wiley, the publisher, and 188 copies were bought by libraries.
Oh, wow.
Yeah.
That's pretty cool.
That seems like a lot, right? I don't know how many libraries are in Australia, but I was surprised.
Wow. Maybe one of the libraries of, maybe the Mount Gambier Library has gone a bit hard and got a few more, going back to your roots, a young lady, role model. Who knows? So then the next question, so we'll put all those links in the show notes so you can find out, because they are great books. So check them out. The next question came from First Gen Building Generational Wealth, all one word. What is the best money saving tip you have ever received? What is the best money investing tip you have ever received? Did you want to go first, Jem?
Oh, I should have thought about this beforehand. Especially since I pulled these questions out. I don't know. You go first.
Okay, so best money saving tip is actually not a money saving tip at all. And we could do a whole podcast about this. It's actually just trying to understand yourself. Because I fundamentally, I read every bloody budgeting book on planet Earth, it feels like. And Scott Pape's book was easily the most profound for me at the time. But even he didn't really talk about this too much, which is this idea of what's money for? What does it mean to you? Even if you have more money, because sometimes I feel like I'm a sieve. Like money just hits me and it just just disappears. And I feel like what would have been way more influential to me, and this wasn't necessarily advice from anyone, but would have been like, hey Owen, why don't you just understand what money means to you? Like, why do you get money and does it disappear? What does your perfect day look like? Do you need money to live that day or do you not? And so that's not really a money tip, but it's more a money tip that I now give to other people because I think it's so profound. It's just trying to understand yourself. We've got a great exercise called the 10 Things activity. You can Google Rask 10 Things activity. I might even pop it down here so people can get it in the show notes, 10 Things activity. Just about using money to bring you joy. For the investing tip, I think that probably the most important thing for most people listening to this is not necessarily my favorite, but the most important for people listening to this is you don't need to do anything crazy to grow wealth. So you don't need to invest in some really speculative thing, buy Bitcoin, do any of that sort of stuff. History shows that just investing in the most boring portfolio of ETFs is probably, it's not going to get you the most amazing results, but it's definitely not going to get you the worst results. And I think that's a big tip for anyone. But probably the big one for me is I do like to buy individual shares and businesses and all that sort of stuff. The big one for me, Gem, is buy super high quality things. So if you're investing, don't waste time with mediocre companies. We call them in the game, we call them gonna companies that are gonna do something. There's this new drone shield company. It's gonna do something. Or, cannabis was gonna be the next big thing. Cryptocurrency was gonna be the next big thing. And none of them are. You're better off just buying solid companies like Wesfarmers that owns Bunnings. And just buying solid companies and just collecting those over your lifetime. That's my big investing tip. So that's what I've got.
Definitely not financial advice to buy Wesfarmers from the compliance person over here.
Definitely not personalised financial advice. But I like Wesfarmers.
Yes. So my investing tip would be the best time to get started is when you're ready. When you've got your foundations and stuff sorted. Don't sit on the sidelines trying to wait for the right time to get started, whether that's property or shares, whatever it is. I think the best time to start is when you are ready, regardless of the market, especially because you should be investing long term anyway. So riding out any market cycles. But yeah, as soon as you're ready and you've got your foundation sorted, I think it's the most important.
Lovely.
Money saving tip. I'd say money management is absolutely around the mindset stuff. It's understanding that money is a tool and that it's a tool to allow you to do the things that you need to do. In terms of actually saving money, I would be buy everything you can on Marketplace. That's my
Oh yeah, that's an amazing tip.
Yeah. And yours would be Costco all the way.
Costco, yeah, it's different. But yeah, I think that's such a good thing. Is and this is probably where I was going. You've probably given the practical answer to my kind of theoretical one, which is by knowing yourself, the thing that I realized by knowing yourself, you don't need all the flashy crap. You realize that those things don't bring you happiness. That's what that 10 Things activity is all about. You don't need all those things in your life to bring you happiness. And I know we know this, all of us listening to this, know that money, we've all heard the studies, money doesn't bring you happiness past a certain level of income. You start to get more depressed from having, more responsibilities and blah, 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 right? Everyone's heard that stuff before. But the reality is you don't know that until you figure out what's right for you. For you, Gem, $500,000 a year might be what you need to feel that level of contentment. I don't know. For me, it might be 50. For someone else, it might be 10 million. I don't know. I think there's a lot of individuality when it comes to money. And it's not really till you look inwards that you can then go, you know what? I don't need to buy a brand new flat screen TV from Harvey Norman. I can just go to Marketplace and get a secondhand one. That's perfectly fine. I think that's a super tip that you've given there. So good stuff. The next question comes from Expeditor. I can use CommSec ETF screener to compare stocks and ETFs. Is there any publicly available tool with no subscription that can do the same sort of analysis/screening like the CommSec ETF screener? I actually don't use that screener, but I know that there is one. It's called Vanguard Fund Compare. It's a tool that allows you to compare ETFs side by side. It's actually created by Morningstar, but it's a Vanguard label on it. But we also have a Fund Compare, which is brought to you by Navexa. So it's a fund comparison tool, and it just helps you compare ETFs side by side. So you could compare, I might just bring this up for anyone that's watching. So
And I think this is really important as well because we talk about when people are think that they're more diversified than what they are. So it's good to compare that if you are buying different ETFs for the purpose of diversification, you actually understand if there's any overlap in them, and then you can make an informed decision around it.
yeah, exactly. So on the Navexa/Rask one, you can get performance, you can get risk metrics, you can see different bits and bobs. On the Vanguard one, you can see a comparison of the top 10 positions. So you can see like if IVV and VGS both have Apple, but you see how much Apple, if that makes sense. So that's what makes that one a little bit probably more powerful. So there's the Vanguard fund comparison tool, and then there's the one that we've done with Navexa, which is way easier to use, but probably doesn't have all the bells and whistles for some people. So I'll put them in the show notes. But yeah, why would you compare? It's overlap, it's fees, it's what exposure do you have in your portfolio. You can get paid ones from like if you have Morningstar, like the paid version of Morningstar. Do you need it? Probably not, to be honest. So yeah, that's that. Next question, Devo. Jem, you'll probably want to respond to this one. Devo says, "Hi there, I love your podcast." Thanks, Devo. I was wondering what your thoughts on bonds are. Is this a financial vehicle that I need to consider only as I get older? What do you think, Jem?
Absolutely get advice, and you can consider them at any age. So there's a couple of elements here. We could be talking about like investment bonds as the actual investment vehicle, or we could be talking about an asset allocation in bonds, which is considered like a more defensive asset, like kind of on this, they generally group it with your cash and fixed interest kind of assets rather than your equities. So if they're talking about bonds as the underlying asset, we do tend to see very generally people kind of move towards more fixed income, fixed interest bonds as they get closer to retirement, because there's generally a little less volatility, a bit more stable. So people will generally consider that, but I don't think it's a hard and fast that you have to. There's lots of retirees that I know that are very, very comfortable with lots of growth assets in their super or their investment portfolios well into retirement. It really depends for you, but yes, a lot of people will kind of mention that bonds will give you a little bit more of that, less volatility. So it might be why they consider it. And then there's investment bonds, which is like a tax vehicle. But I think here we're talking about an underlying investment strategy.
Like a government bond or something like that.
Like a government, a bank bond, that generally have a lot more, stable returns that people would liken them more to cash, fixed interest like term deposits and things. There's still absolute risk with them, but they're considered more defensive than what a equity like a share or an ETF or something would be.
Yeah. Good point. So let's maybe start the top down. So when you build a portfolio, like a proper portfolio that you're not kind of just guessing about, a lot of the more modern content creators and stuff like that have never really seen anything bad happen in the stock market. Like we've kind of just become used to stocks going up. But if you go back, like in basically any other point in history, you'll see that stuff can go wrong and quickly. And that if you get your information from like fund managers or you get your information from different like online sources, you might be inclined to think, well, all I need to do is just buy 2 ETFs that have shares and that's the best performing in history. You'd probably be right, because history does show that shares go up. But as you get closer to retirement or early retirement and you need more income, having those other sources of income provide 2 major benefits. One is stability in your portfolio and the other one is consistency. And so bonds aren't just for old people is what I'd say. We have some people in their 40s and 50s who have actually quite defensive portfolios. Like they've either inherited money or they've built a business and sold it.
They just don't need to take the risk to achieve what they want to.
Yeah, exactly. If you want monthly income that's really reliable, you can use bonds, you can use term deposits, as well as shares and ETFs and that sort of stuff in the general sense. And so I wouldn't say they're just for old people or older people. Like even in our most popular strategy at Rask Invest is the Jupiter strategy, which is 90 growth and 10 defensive. And in the defensive side, there's a few bits and bobs in there that are kind of like that. They're more defensive, less risky. And the purpose of having that in there is that so when the market does fall eventually, you can then use that little 10% to top up on the things that have fallen, and you can rebalance into different things that might be cheaper. So some people think that when the stock market's going up, like it has in the past 3 years, and everyone thinks they're wonderful at investing, people think, well, why would I have any defensive stuff? This was like just after COVID, everyone was saying the same thing. They were going like beta shares, all growth IVV, like all growth Vanguard. And it was obviously later on that people found out that maybe isn't always the best thing to do. So build a good portfolio. Don't forget about the defensive side. Do you need that much bonds if you're younger? Probably not that much, but still worthwhile understanding them, at least trying to. I know they're pretty scary.
And I think you'd find, like, if you looked at your super, regardless of your age, you've probably got some in there. So it's good to understand what that asset class does. But it serves a purpose in portfolios, in part of the pie. We do definitely want to be diversified and, have exposure to all different assets classes that are going to perform differently at different times.
Yeah. Just on that, actually, I've been seeing some content lately, particularly on social media, about like people are really focused, on really low fees. Really getting the lowest possible fee, which based on financial industry standards, it makes sense to go for the lowest fee. But what people don't understand is that it's sometimes the behavioral mistakes you make could outweigh the benefit of 10 years of lower fees. And I genuinely mean this. Like, say, for example, during the Trump thing recently, if you sold out when it was down 10%, if you spent the previous year thinking that, I'll choose between VAS or A200 because it's got 0.03% better fees, but then you just lost 10% because you were too scared when the market fell, that's like 400 years worth of fee difference. And so there's no real point searching for the lowest fee and having all shares and those types of things. Having a balanced portfolio, yes, you might give up a little bit of the upside, but you might get more protection when the times are scary. So I think there's a few myths getting around about what good investing is at the moment, and not having any defensive things is an important one that people should consider, particularly as they get bigger portfolios and they start to rely on their income. In other words, maybe financial advice, or maybe just do some research because, even just a little bit might make sense over the long run.
Absolutely.
Cool. So this is a Super Confused question, comes from Super Confused. Here they go. They say, so I am in a very fortunate position where my employer's superannuation guarantee contributions exceed the $30,000 annual limit, which people will know is the $30,000 is the limit for what we call concessional contributions. That includes what your employer puts in. My wife salary sacrifices to reach her $30,000. So what she's doing is she's adding more, whereas he's not. He's just got a very high income, and the default amounts that are going in exceed the $30,000, which is a great position. They go on to say, I heard about spouse contributions in your podcast earlier this week. Would it be more tax effective if I transferred all of my contributions that are over $30,000 from my super to hers and correspondingly reduce her salary sacrifice? Now, this is a question that Gem and I spoke about off air for a while because it does have a few moving parts, Gem. So
it has a lot.
You're the super expert. Talk us through the basics. Talk us through the more nuanced parts of this.
Okay, so let's talk about, so yes, there is a $30,000 limit on concessional contributions. That means before tax, either what your employer puts in for you or what you use to reduce your taxable income. Like salary sacrifice, you claim a tax deduction for it. If your balance is under $500,000, potentially you might have some unused caps from other years. If this person's on that kind of income, I'd say they probably don't, but they might, okay? So they might be able to go over that 30 limit. But the other thing that they're talking about is can they, about transferring the money to the spouse. So what that is it's called a
Super split.
Yeah, super splitting. Sorry. Yes, thank you. So you can split up to 85% of the contributions to a spouse. So the reason that it's up to 85 is because when your employer puts the money into your super fund's already taken 15% tax out, and potentially for this person, they're actually going to take another 15% out. Okay, so potentially, because they're what we call Div 293, they're a higher income earner. So you can split up to 85%, but potentially this person could move maybe 70% over because there is going to be that tax that comes out. So they can't actually transfer it all. There's going to be a limit because some's gone to tax. So that's the two things. How concessional contribution limit works and how that super splitting works. In this case, they've asked, should they transfer that to the spouse and then her not do salary sacrifice? They're actually two different things. So from a tax perspective, it doesn't help because the contribution going into her super fund from his is after tax money. He's paid the tax. It doesn't form part of her salary sacrifice. She can't claim it as a tax deduction. She hasn't added it. So you would do it if you wanted to even up balances, if you wanted her to stop salary sacrificing so you had more cash flow. But from a purely tax perspective, it's not going to make you better off. There would be other reasons you would consider it, absolutely. But they've asked specifically if it would help with tax, and it wouldn't because you're talking about her stopping salary sacrifice in that case, and which would increase her tax.
Yeah, so that's a good point. So if you're listening at home and you've say got $100,000 a year salary, just for round figures, and you have 12% salary at super contributions from your employer, that means that 12% on top of 100, you're getting $12,000 going into your super every year. The limit for this tax advantage version is $30,000 every year, ending on June 30th. So in effect, you've got $18,000 extra that you could put in and claim a tax deduction for. That and put in and claim a tax deduction is sometimes called salary sacrifice because that's what people felt like that was the only way in the past that you could get extra money in through this way. But now you can just put it in through BPay or whatever and just claim a tax deduction. The thing that happens is it would only apply to probably 5% of people on our podcasts, is that if you have an income that's sufficiently high enough that 12% of your income is above $30,000 anyway, it's known as something called Div 293. It's a particular ATO kind of ruling. And what it means is that the amount that over the top of that $30,000 is not necessarily, as far as I'm aware, not necessarily mandatory. So most people just leave it in there, but some people you may not have to. But to summarize Gem's point, basically when you do put money into super and you look at these numbers and stuff, it's based on whose money is going in. So for example, in this sense, say that's he's got the bigger super balance and the bigger income that's pushing that money in, it counts towards his caps. That's probably the key thing to understand. It's his caps, right, Gem? So the 30,000 is his limit, not across both of them.
Yeah, that's exactly right. So so from a tax perspective, probably not. Personal advice would be really great to look at what are all the other things that help you in a tax strategy where you're building wealth, how you're utilizing superannuation. But yeah, that's I think just the details in that, it's not as clear cut as yes, that would be of benefit.
Yeah, cool. Like it. Free Money Hacks has asked a good question about Raiz rewards. How does Raiz rewards from like the surveys and stuff or the cashback that you can do with them from shopping work in terms of income? So you can do the surveys and get a little bit of cash, but you can also do the cashback things where you go and you buy things through one of these cashback platforms and then you get money invested or sent to your bank account. Is it free money essentially that is then invested? It's a good question.
Yeah,
Gem?
well, essentially, yes, I would say it is free money, right? It's like a little refund on what you've paid. So it's like you getting a little bit of, say you paid $100, you might get a couple of bucks back. So it's kind of like, free money because you were going to buy that item anyway, but it's more like you've got the item at a discount. Does that make sense? Is that how you would explain it?
Yeah. Because it's like you've paid for it. You're just getting some of it split back to you.
Yeah, it's like a little refund as if they got you a discount, I guess. So it's you're getting some of the money refunded, because what is happening is if it's Raiz or Cashback or Shopback, whatever they are in a partnership with whoever they have on the platform. So they're getting a commission or they're in some kind of remunerated partnership. So they're giving you a little bit of what they got paid to advertise. Is that kind of how you think? Yeah.
No, it's like, absolutely. It's just like that. There's a lot of those types of arrangements where you pay some money and then somehow you get money back, or someone else makes a profit just from you paying a number. Like, remember how they used to do those, like, is it like Daikin or one of those Mitsubishi air conditioning type things? Like you could get like $100 back if you bought that specific air conditioner or something like that.
Yes, I was looking for a new washing machine last week or the week before, and they were doing that. They were like, oh, you'll get a cashback in a gift card, or you write directly to the manufacturer and they'll send you something. And like even health insurance and stuff do it as well in a way. They're like, once you've been, some might say once you've paid for 6 weeks or something, you'll get a month free. Like, I guess it's kind of the same as that. It's more either a refund in your money or, they're just splitting back some of the profits that they've got. So essentially it is free money when you look at that, if you think of it in the way that you were going to pay full price for the item and now you've got a little bit back. In the Raiz example they've used here, they said, is it free money essentially that is then invested? Yes, because Raiz automatically put that into your investment fund. Whereas if you're with like a cashback site or something, like I use, I think it's Shopback or whatever, not a plug for them at all. But it just tallies, and then every now and then I go in and withdraw it. For cash. So it just depends on the platform. But yes, Raiz is using it and automatically investing it for you back into your portfolio.
Yeah. Let me know, everyone, if you want me to write a letter to Brendan, the CEO of Raiz, for not having Booking.com on the platform anymore.
What's the go with that? That
was my favourite one.
Yeah, I think it's off Shopback too. I don't know.
I think it's a Booking.com thing. I don't think it's a Raiz thing. But I used to like gorge myself on that. Like I would spend all of my holiday planning, all of my work planning, I would book through the Raiz app for Booking.com, and then get the Genius points, and then get the cash back into the investments. It was such a good way to do it. And there's still heaps of cool stuff on Raiz Rewards, by the way.
And this episode is not sponsored by Raiz, but they are. No. They are. We do a lot of stuff with them. But yes, this person.
A lot of educational stuff with them. But they're all really cool. This is just a quick one. I know, just conscious of the time, but this is the mystery of how Afterpay gets paid. For everyone that doesn't know, how does Afterpay actually get paid if you don't pay late fees, right? It's because they have like an inbuilt fee that when you use Afterpay, the person or the company that you're buying from pays Afterpay a split of that.
The merchant pays big bucks.
Big dollars. That's why they put up the prices oftentimes for people that use Afterpay. So you might think you're getting it like paying for it's no interest. It's actually you pay more over time, and a lot of society would end up paying more. Kind of like the credit cards.
But also with Afterpay, the merchants, so that merchant is like the shop, right, that sells the item. They're usually happy to pay these big fees because they know that when people use services like Afterpay, buy now, pay laters, they're likely to spend 20, even up to 40% more than if they had to use their own money. So they're like, yes, I'll pay your ridiculously high fees if you let this person pay in payments without interest, because they make more money as the store as well. So it's a vicious cycle.
Yes,
and the only people that lose is the consumer.
Yes, indeed. Scared adult child. This is not me. It's they've written in and said, this is a final question for today. I hear a lot about this great wealth transfer, but unfortunately my parents are terrible with money and both spent away their money after their divorce. Both are renting with little savings left over and have had their heads buried in the sand. I feel stressed about my future and resentful towards my parents. My siblings and I will have to financially support them in their retirement. I can't help but compare my situation with my friends whose parents have $1 million plus properties, and planning their retirements. How can I flip the narrative in my mind so that I don't carry this resentment forever? My parents are amazing, but I can't help feel annoyed at their negligence when it comes to their finances. Absolutely hell of a question.
This is a
Gem.
lot. This is a lot. So perfect timing for this question, because on Monday this week, and I will link it in the show notes, I did an episode with Betsy Westcott, who is a money coach and a financial commentator, and we talk all about this. We talk about what the great wealth transfer is, that $3.5 trillion is about to change hands, but who it's likely to go to, and how do you cope and move forwards, and what do you do if you're not actually going to be receiving any, because that, that is hard. And yeah, so this, I would absolutely recommend you listen to that. It's like 40 million hour, and Betsy talks about all of that. It's a really hard position to be in because there's lots of layers there. You are impacted if you have to financially support them. So it's not just that you get a leg up from inheritance, but if that actually impacts your own ability to build wealth because you're supporting them, that's a scary, hard place to be in. So if it was just the fact that you weren't going to get an inheritance, I think that might be a little easier to kind of deal with. You go, right, well, I put my own oxygen mask on. I'm in charge of building my own wealth. It's all relying on me and I hold the reins. That's a bit more empowering than I'm going to be held back financially if I have to contribute. So yeah, this is a really, really hard one. And I would encourage them to probably talk to maybe a money coach is the way to go with mindset and different things. Getting solid with your financial plan, how you're going to be financially okay so you're not in the same position as them. But I think it'll be a lot of things around mindset and maybe some psychology. Resentment is a horrible, horrible feeling to carry. And this is such a deep one. I know, we can't solve this in the podcast, but I really feel for this person. This is a tricky spot.
To be honest, I feel the same obligations towards my family, for what it's worth. And it's just something that you just kind of have to live with, because there's no way about it.
Some cultures, this is a given.
Yeah. In a lot of Asian cultures, you have to do this, right?
Yeah.
This is the responsibility, and I would just say, take the good with the bad, and maybe just be honest with them as well. If they're the types of parents that you say they are, when you say that they're amazing, being honest with them might actually genuinely help to make a change in your life. And we've all got stories of people in our lives that we feel responsible for, or things have happened, and sometimes bygones be bygones, right? And the best thing to do is oxygen mask. Just like they tell you when you get on the plane, is put your own oxygen mask on first before you put it onto someone else. And I know for some people that might seem a bit selfish, but how could you help them if you're not financially well? So you're doing the right thing. Share this podcast with them, or share some resource with them that they might relate to, because they might have shame themselves.
And I think maybe having the conversation with them, because a lot of the time we internalize problems and the thought and put the pressure on ourselves. Maybe if you haven't actually had a conversation with them about how they feel they're going to support themselves and things, maybe they actually have a plan. Maybe I'm hoping this is the thing, that maybe you feel like it's a bigger problem than it actually might be. But having that conversation with them, if you are going to be financially supporting them, or you're worried that you are, you need to be having those really open money conversations, and giving them as much support to solve their own problems. Maybe it's them, saying, well, you need to talk to a financial advisor. You need to talk to a free financial counselor. Maybe it's that they're nearly at Centrelink age, or they are, and they could be talking to a Centrelink financial services officer. Giving them the tools to help themselves is probably a great step before you give them the money to help them. But we don't know enough, but I think I feel for this person. And if they want to reach out and have a conversation with me, email us at what email address?
service@rask.au. Is this on the contact us page?
Yeah, perfect. Email me, we can have a chat.
Yeah. Yeah, absolutely. So it's unfortunate. It's a position that you're in. You didn't get that's just a bit of unlucky, I guess, in the gene pool there, but it's not all gone yet. So safety mask first, and then maybe pass on some education to them and some honest conversations. So we did have some great questions through today. We'll put links in the podcast for books and these types of things. Money tips. Gem had a few good ones for us there. Expediter, you asked about ETF screeners. There are 2 that you can use that are freely available. Devo, you asked about, do I need bonds? Maybe just try and learn a bit about them. It is a steep learning curve, but just try a little bit more about them. Super Confused talked about the taxation and optimization of super contributions. If you're a high income earner, you should get financial advice because it will be effective for you in so many ways. Free money hacks. Raiz Rewards is a good one. Shopback, Cashback, they're pretty popular too. I don't use them myself, but they're good ones. Scared Adult Child, the emotional side of the wealth transfer. I hear what you're saying, and there are strings that you can pull. Try to just work with someone with the resentment piece. So those two, because there may be some shame
check
from
out
their
that
end.
episode.
Yeah, definitely with Betsy.
Check out that episode. That's really good.
Yeah, cool. Well, Gem, this has been heaps of fun. I know that book that you said you wrote, it's called The Money Guide, is it?
Oh, yeah. That book I wrote, what is that called? Oh, The Money Reset. Yes, The Money Reset. That's out.
Money Reset. It is out now.
Not sold out on Amazon like Drew's is. So.
Not sold out. So head to Amazon. We'll put a link at the top of the show notes. It gets priority spot. But you can also find it at good bookstores or even your local library. Go and check that out too. So if you request it from your library, they will buy it for you. So that's a good way to kind of make sure you can reduce, reuse and recycle. All those good things. So, Gem,
that's a money hack for you. Use your local libraries.
Yeah, absolutely. And most local libraries these days have apps as well where you can download audiobooks sometimes.
Audiobooks, And you can go in and like print and stuff from them as well. You can work from there. Yeah, like libraries are pretty cool these days.
Some of the big regional cities across Australia, I was in Albury not too long ago. I think it was Albury. They have a fantastic library. I was at another one up near Canberra. It was so lovely. I'm like, these are beautiful spots and you can just work from like co-working. So
and when Charlie's a little bit older, they do like all the little kid groups and then they've got the play section. They do mums and bubs or parent and bubs classes and stuff. Yeah,
we've started going. So that's good fun. A lot of hippies up my way trying to spread some good juju through the libraries as well. So all good fun. Well, Gem, absolute pleasure. Always good to chat. So thanks for joining me.
See you next week.
Thanks for watching this episode of the podcast. If you want to hear more from us, you can get daily videos and podcasts on Rask's YouTube channel. Or if you want to enroll in a free course on investing, property, business, money, you name it, you can join over 34,000 other students and enroll in a free course on the Rask website. Simply head to www.rask.com.au and follow the prompts. Thanks for watching this Rask podcast.